Hi there, and thank you for joining us for this episode of PhillipCapital's Market Watch. I'm Joe, a CFD dealer from Phillip Securities. In today's episode, we will take a closer look at gold, its historical significance, the key drivers behind its price movements, and whether current market conditions justify keen investor interest. Let's dive in. Gold has been prized by civilizations since as early as 4000 BC. In many ancient cultures, gold symbolized wealth, power, and even divinity. For instance, the Egyptians associated gold with the sun god Ra and believed it represented eternal life. This deep-rooted culture and religious significance established gold as a coveted material from the very beginning, a status it continues to hold today. Several of gold's physical characteristics contribute to its status as a safe haven asset. As gold does not rust, tarnish, or corrode, it can be stored for external periods without deterioration, making it a reliable store of value across generations. The scarcity of gold enables it to maintain value sufficiently, yet not so rare that it cannot function as a medium of exchange. The total amount of gold ever mined is estimated at approximately 244,000 metric tons. Its limited supply cannot be easily expanded, unlike fiat currencies, which can be issued by central banks. Furthermore, gold is highly malleable and can be shaped into coins, bars, or jewelry. It can also be divided into smaller units without losing intrinsic value, an important characteristic for trade and exchange. In recent years, gold prices have reached record highs. Several macroeconomic factors have contributed to this trend. One key driver has been aggressive monetary expansion by central banks, alongside large-scale fiscal stimulus measures introduced by governments. As the supply of currencies such as the US dollar increases, the purchasing power may weaken over time. When the US dollar depreciates against other major currencies, it typically takes more dollars to purchase 1 ounce of gold. As a result, gold prices tend to rise in dollar terms. Recent geopolitical tensions involving the US and other major economies have further heightened uncertainty surrounding currency stability. This environment often leads to a flight to safety, with investors allocating capital to traditional safe haven assets such as gold. As gold prices reach new highs, some investors begin shifting funds into silver, viewing it as a relatively cheaper alternative and speculating that it could follow a similar upward trajectory. This momentum-driven behavior can become self-reinforcing, contributing to price increases in both gold and silver. Media coverage has also amplified investor interest, bringing discussions about precious metals into the mainstream and encouraging greater participation from investors. This brings us to the quick question: should investors consider allocating their funds into gold and silver at current prices? Gold and silver are currently trading near their all-time highs. Investing at these levels means there is a risk of entering the market close to a peak. If global conflicts ease or inflation is brought decisively under control, prices could experience a meaningful pullback. Therefore, it is important to decide whether the potential benefits of investing in both gold and silver today outweigh the associated risks. Approaching this decision with a disciplined cost-benefit framework can help investors avoid the common mistake of buying at elevated levels and selling during periods of fear. As the saying goes, a shrewd investor will always buy when the market is fearful and sell when the market is greedy. A good way to determine whether gold and silver prices are overvalued or undervalued would be to look at the US interest rates relative to inflation, as real yields are a key driver of precious metal prices. Currently, the US 10-year Treasury yield stands at approximately 4.24%, represented by the dark blue line. US inflation, shown by the shaded green area, is around 2.7%. The positive return on bonds net of inflation, represented by the red arrows, should under normal circumstances pull investment away from these precious metals. The fact that gold and silver remain at such elevated prices today suggests that other factors such as massive central bank buying and high geopolitical risks are currently overriding this traditional fundamental indicator. The recent pullback in both gold and silver prices may reflect growing investor caution around potential overvaluation, with some market participants taking profits ahead of a possible correction. In such an environment, it becomes important to adopt a disciplined framework. Instead of reacting to short-term price movements, investors may consider waiting for prices to retrace towards established technical support levels before reassessing entry points. At the same time, macroeconomic indicators, particularly interest rates relative to inflation, remain key considerations. When real yields become less attractive and price levels align with strong technical support, the risk-reward profile may become more favorable. From a technical perspective, based on the SPDR Gold Shares ETF price chart, the US $440 range may represent a notable support zone for gold. For silver, based on the iShares Silver Trust ETF price chart as at the close of 10th of March 2026, the US $65 range may represent a comparable support area. Historically, waiting for clearer technical support and supportive macro conditions has helped reduce the risk of entering positions at elevated levels. Ultimately, investment decisions should be guided by a balanced assessment of valuation, macroeconomic conditions, and portfolio objectives. Thank you for joining us for this episode of PhillipCapital's Market Watch. Do like and follow us on social media and subscribe to our YouTube channel for more insights. Before we conclude, share your thoughts with us in the comments section. Do you view gold and silver as investment opportunities for 2026? We look forward to hearing from you, and we'll see you in our next episode.